Hey guys, Corey here. Welcome to Blue Talks, and I hope you enjoy this video. Okay, well, welcome everybody to what I consider to be almost like a virtual podcast interview, if you want to call it that. For years, I was doing the podcasting thing. Originally, I had newspaper, then I moved to podcasting, then I moved to video. And what I really like about this is the idea of being in front of an audience and feeding off that energy, which you normally don't get in a podcast if you're in your parents' basement recording, which is some of that. Believe it or not, some of the biggest shows are being recorded in somebody's basement. So I like the idea of being in front of a live audience. So having said that, what we usually do with our guest, Donny, is to get them to introduce themselves. So, Donny Mangos is here with us, but Donny, can you give us the Reader's Digest version about you, and then we'll dive right in?
Okay, sure. Well, I'm a speaker. I'm an author. A day job is more of a wealth strategist, so I'm an advisor. And I created a strategy called a money mansion. So I'm kind of an architect of this thing called a money mansion. How's that work?
Yeah, that sounds perfect. So what I wanted to talk about is there's definitely strategies when it comes to wealth creation that we can employ, correct me if I'm wrong on this, that probably the average person doesn't. So in other words, is it safe to say, let's say entrepreneurs are possibly paying at least more tax than they should be?
I think that it's not possible. I think that they are absolutely paying more tax than they ought to in Canada. And the reason I know that is because I see this day in and day out. So I know the system. I understand the tax system. I get it. There are not a lot of opportunities for people that have a regular salary income to find a way to pay less taxes other than some of their RSP stuff. But business owners, absolutely, I am telling you, you are leaving money on the table for sure.
And I mean, we'll dive into it, but does this book get into that?
It does. In a small part in the chapter. So it's a more of a general purpose book talking to the human here, not the corporation. But corporations, there is a section in there saying, hey, hands up, you may want to consider this section right here. So yes, it does.
So for the people in the room that maybe in different perspectives, we might have solopreneurs, we might have people that haven't been in business and people that are in a business where they're the manager or the owner and multiple employees, or people watching obviously the same. So people often wonder, like, should I incorporate? Should I not incorporate? And I know it sounds very basic, but I'm just wondering for the average person that doesn't know the difference, should everybody always incorporate, or are there times whenever they should?
This is an amazing question. I'm glad you brought this up. This was not a plant. This is a great question. So typically when you're starting a brand new business, you don't really know if it's going to go well. So you don't want to go through all the effort of incorporating, spending the couple $1,000 to get started, annual costs of filing corporate returns, all that stuff that you just don't want to get to. So you don't do it. And the CRA in this case, imagine this is you, Corey, this is you, and you're starting a business. Your business and you are the same thing. So to the CRA, you're subject to personal individual taxes, which just happen to be the highest tax rates around. Okay, Canada's super heavy on taxation, but you're paying, if you hit this number, you're paying up to 53.53% of what you make in income tax. Now, if you had a corporation, if you were forward thinking and you said, I'm going to start a corporation instead of earning money into my personal name, you had this thing on the side here. This is your corporation. This corporation in Canada for the first $500,000 of income charges 12.2% tax. Therein lies an opportunity to use structure and strategy to minimize what you're paying in tax overall. There's 40% difference in tax savings potentially to the business owner in Canada.
And I think and again, I'm asking you as the expert, but I feel like there's another aspect to it, because I looked into this in different companies I've had, is if you're a solopreneur or sole entrepreneurship structure or sole proprietorship, if you want to sell it down the road, it can be sold and they're going to base it more on your revenue then, versus if it's an incorporation, they see more value because there's no risk, first of all, but then the corporation can own trademarks and all this stuff a little differently than a sole proprietorship. Is that correct as well?
That is true. So it's just easier to detangle or uncouple your business from you over here if it's an actual separate entity, all you got to do is change the name of the person who owns the shares of that company. The company itself remains the company. But if you are the company, it's just, it's all connected. It's really difficult to separate out. And you're going to expose your own personal income to whoever's going to buy your company so that they know exactly who you are and what you make.
Right.
So there's a little bit of leverage play there. So if you're thinking, I'm building this business and my intention is possibly to sell it in the future, yeah, absolutely. You may want to consider the extra couple of bucks to set it up, get everything off to the side, nice and clean, ready to transfer.
Would you say, and I don't know if you know these stats or numbers, but would you say there's a large percentage of entrepreneurs in Canada that stay a sole proprietorship and then eventually go, I think I might sell this later on? Like, in other words, I think I'm going to retire, like a plumber, let's say, and they built this.
Yeah, I wish that was the case, Corey. A lot of people just abandon. They wind down without actually having a purposeful plan to liquidate and sell this business. So they do, 30, 40 years of building this thing, and they just stop taking on clients. They just sort of wither away, and they lose all the goodwill, all of the trademarking, all the stuff in the business.
So even as a proprietorship, it'd still be better for them to have it so they can sell it or turn it into a corporation. But if they didn't, so yes, still be better off to sell it than to walk away.
You should do that. Everyone who's building a business, you should at least give consideration to that. That alone is enough reason to go this route of setting up a corporation, just so you can aspire towards selling off something at some point. What's the point of doing everything you're doing here if you're not building towards a positive outcome for yourself?
Well, and I will say, for me, one of the reasons we moved away, we used to do as a speaker first, you're a sole proprietorship. At least you should be, right? Not just like me as a speaker and people just paying in my name, and you at least should set it up as some form of company. And so as a proprietorship, you kind of think of these things differently. But one of the things I moved away from about 6 years ago was the reason we went to bLU Talks. You notice it's not Corey Poirier Presents or Corey Poirier's bLU Talks. Well, originally I used to do speakers boot camps. Like if I had a boot camp with 200 people, it'd be like the Corey Poirier speaker boot camp. Mm-hmm. And I didn't really care that my name was there, but you had to have some name because it sounded pretty generic saying the speakers boot camp. And so I have my name in it. And at some point, so here's what happened. I thought about Tony Robbins and Jack Canfield. And I said, both of them have built, like Tony's case, like, I don't know, $500 million a year.
Huge
revenue. But he has multiple companies. But the Anthony Robbins, whatever it is, I forget the total title, but Anthony Robbins Associates, Inc. or whatever. I always thought about if something happens to Tony, what does that business look like? And I don't know the answer to that. But like he has people that do all this stuff for Tony. But at the end of the day, people that go to the live events pay more when Tony's there live. And then they pay less, but still more if Tony's on screen. But what would they pay if Tony's not there or even with the company anymore? So I started looking at that. Same with Jack. Jack just retired and they're trying to keep the company going. But what is that company then? It's Canfield Training, but Jack's not affiliated. So those, as a speaker, I started thinking it can't be the Corey Poirier company. So I started bLU Talks from day one is like, let's build this like a franchise, even if we never sell it.
Yeah, I think it's a great strategy because you just never know. And this gives you motivation to go out and build it some more. I mean, really, it's just having that structure in place pushes you to get up in the morning, maybe a little earlier, and go and find your passion in that business because you can build it towards some means to an end.
So here's a question for those listening, those in the audience that might be working for someone else. What do you suggest or recommend to people that they start a business on the side as a side hustle? Obviously I think we know there's tax benefits no matter what, and I think there's a few years you can claim a loss, and I'm not trying to tell people to set up a business just to lose money, but you can claim that and that can help you with your taxes. But do you think everybody should have a business, or is it just people that?
Okay. If you can find a way to create revenue from what it is you're doing, that's not in your job. So it may not even be a choice, Corey. If you're working for somebody else, one, you may be prohibited from taking other income. That could happen. Your employer might say, absolutely not, ixnay on that. But if you could find a job or a stream of revenue that you can generate into your name directly, somehow, some way outside of your course of your business, you're creating opportunity to at least be able to write expenses off against generating that revenue. So you're introducing deductions all of a sudden, whereas before you didn't have that. You can't write off your mic if you are working for somebody else. There's no revenue attached to that.
Right.
So it gives you an opportunity to do that.
And probably a portion of your house and those kind of things. That you're truly using it for the business.
Certainly. I mean, even people that own real estate as a rental property, that's a business. And there are deductions associated with operating that business. So there's access to deductions that you wouldn't have had if you didn't own that other property.
Yeah, so a friend of mine, this kind of weird scenario, but a friend of mine, you mentioned sometimes you might not be able to work. He was trying it for the RCMP, and he's like, I found it at how much you make, and it's not as much as I thought. So I'm going to run my construction business on the side. And I said, have you talked to the RCMP about that?
Yeah,
Because for me, I'm thinking like, if you're an RCMP officer in that same community and you're also building houses, would you maybe turn a blind eye then if somebody's doing that? Couldn't that be a conflict of interest? So I'm saying maybe the RCMP will tell you you can't go out and work for 50 homeowners in an area of 1,000 people.
It's no different than if you sold your business, for example, and I'm not suggesting that someone's bought. I hope you sold your business for a lot of money, Corey. But if you did, you might have all right, listen, Corey, you can't do this for the next 5 years, though. You can't actively promote green talks. I know blue's an acronym, but you can't do that for a little while. So you can put blocks in place if you are dealing with employment.
Yeah, I mean, that's a good point. And he's open about this, so I think I can say it. But there's a guy I know whose name is Kyle Wilson. And Kyle used to work for Jim Rohn. And he used to own, actually, Jim Rohn International. For those that know, Jim Rohn was the speaker. Kyle built his business, and part of the deal was he owned Jim Rohn International. And I think it was after Jim passed away, Kyle was still running it. He sold it to Success Magazine. And the deal was he couldn't, and I don't know how far it went, but I know he basically retired for 5 years. But I think he couldn't do anything in the personal development space, which was his whole jam. And now 5 years has passed and Kyle's at it hardcore. Yeah. But what I mean is, to your point, he couldn't do anything for 5 years. I think all of personal development's pretty broad. It's like you're basically saying you can't earn a living anymore, and you could probably fight that in court. But if you signed the agreement and you agreed with it and you got enough money, then you may do it.
We talked about contracts. Contracts can predict the future. I know that if I say you can't do this anymore, guess what, Corey? You're not doing it anymore. If there are consequences, you're not going to do it. So it's very limiting, of course. This is your scope. This is where you can't operate anymore. You just got to follow the rules there for that period of time.
So as we wind down, I'll say it this way. What would you say is the number one in your mind, or off top of your head as well, takeaway when somebody reads the book? Like, what's the number one thing you want them to take away about wealth creation?
I want them to see that they've only been exposed to one side of the world. I talked about hope-based decisions and hope-based financial planning. Yeah, that isn't the only way to do things. I want to know. I don't know why. It's not a control thing. I just want to know the results. And I want you to know that there is an option beyond just what everyone else is doing. I really am not a fan of conventional advice. I don't know how it became such, but somehow we've all just agreed that these are the rules and we got to accept it. So I want to just encourage people to think, and that's what the book is meant to do.
So I'll say this is the last official question, and then the unofficial one's going to be how can we learn more, get the book, all that kind of stuff. The last official question I'm curious about, when you talk about contrarian advice around wealth, I think of right away The Wealthy Barber. If you guys, I don't have people here would remember what I mean when I say The Wealthy Barber. It was a book that was really popular in Canada about how to create wealth. And the big takeaway from that book, I believe, was like to save 10%, invest 10%. Like, it was take the first 10% before you ever spend a penny, which I think for the time was kind of groundbreaking, which doesn't seem like it now. And then the other person was Robert Kiyosaki with Rich Dad Poor Dad. And he kind of came with the unconventional wisdom that your house is not an asset, which people lost their minds over because that's the biggest thing we own. And you're like, wait a minute, you're telling me. Now, his argument was, if your home is paid for, then it's an asset. If your home is generating revenue, in other words, you have renters downstairs and you're generating revenue that pays for the house, it's an asset. But his whole thing was, if you lose your job tomorrow and your house now, you owe money in the house and it now becomes a liability, like you could lose the house and everything else, then that's not an asset. My question is, what are your thoughts around that type of thinking?
Okay, so the Wealthy Barber side, he's big on saving. I actually do not believe you can save your way into prosperity. So I think he's a little bit more conventional in his approach. You can't. My dad could, but a lot's happened since then. So it's like inflation is off the charts. Taxation, you can't save your way into prosperity. Kiyosaki, now we're talking. He's thinking outside the box. He's looking at houses and saying, if it takes money from your pocket every month, that's a liability. If it puts money in your pocket every month, it's an asset. It's a different way of considering it than an accountant would, for example. And we believe what accountants say because they're the authorities for whatever reason. So contrarian is saying, Wealthy Barber taxes, put your money into RSPs and things like that. That's pretty typical advice. And I just don't believe that is the only advice. I think that there are outcomes that you can create and engineer that go far beyond what everyone expects. Yeah.
I love it.
Yeah.
So the last question, like I said, is how can we learn more? How can we get the book? What's the...
Yep. Wealthup.com will get you everything you need to know about me, about the book, all that kind of stuff. More photos, podcast, all that stuff.
Amazing.
Thanks, Corey.
Thanks so much, Donny. Absolutely appreciate it. Thanks, everybody.
Awesome. Thank you.